It's been a good year for stocks. The Vanguard Total Stock Market ETF, ticker symbol VTI, ahead by 21%. But will it last? Here to talk with us about that is Rick Ferri. He's the founder of Portfolio Solutions, manages just shy of $1.3 billion in assets. He's also author of the ETF book. Go pick up a copy at Amazon. Rick, welcome to the Index Investing Show. Great to have you with us.
Thanks for having me back, Ron.
So the U.S. stock market trading near all-time highs, and some people say that today's price-to-earnings ratio, or PE, is a sign that the stock market is overvalued. Others argue that it's a sign of improved earnings growth in the future. How do you see it?
Well, it's probably neither. It's 18.5 times earnings, which is simply the price of the S&P 500 divided by the number of earnings, the amount of earnings that the S&P companies in aggregate have earned in the past 12 months, is around 18.5, which is, as you said, higher than the normal. The normal, if there is such a thing, is around 16. So we're slightly higher than normal. Is this a sign that the market is overvalued? I don't believe that it is a sign. In fact, I was just looking today at some more research and said if you would have bought the market back in 1961, the PE back then was also 18.5. And if you would have just held it at 18.5 PE through time, you would have earned yourself a nice compounded return of about 8.5%. So as long as if you're buying at 18.5 PE and you're selling sometime in the future at 18.5 PE or higher, you're going to do just fine.
If you're just joining us, you're listening to the Index Investing Show. We're talking with Rick Ferri, author of the ETF book and founder of Portfolio Solutions. Now, many large brokerage firms like Fidelity, like Schwab, like Vanguard are now catering to investors with commission-free ETF trading. This is the rage. What is your view about commission-free ETF trading, and what are the potential pitfalls?
Well, my view on free ETF trades is that nothing is free. It might be commission-free, but when you buy or sell anything over the stock exchange, and all ETFs are traded over the stock exchange, there are other fees involved. There is the spread between the bid and the ask, and there's also sometimes trading costs internal within that are shared between different brokerage firms. So commission-free trading does not mean free trading. And also, that doesn't mean that the ETFs themselves are free, because the ETFs have expense ratios within them. So putting the word free in front of something doesn't mean that everything is free. Now, are they a good thing? Yeah, I think that it's fine if you wish to invest in ETFs for the long term, and you're at Schwab or Fidelity or one of the other brokerage houses, Vanguard, that allows you to buy and sell ETFs for free, that you can, it's a way of keeping your cost a little lower. But again, you have to look at the total cost of trading ETFs, not just the commission part. But look, hey, I'm all for, keeping costs down. And if this does reduce the cost for some investors, then I'm all for that.
And then also, too, there's the cost of a limited menu of ETF choices, because this just includes each brokerage firm has its own little menu that's limited in terms of which funds you can actually purchase without incurring any kind of commission. So that may limit you from a portfolio construction perspective.
I think that most of the companies that are giving you free ETF trading, they're core funds like the Total Market Fund or the S&P 500 Fund or such. The core funds where you can build a portfolio are, there's availability of free commissions on those. I think that once you get into more defined, esoteric, non-core ETFs, you're not going to find too much commission-free trading on that.
Rick Ferri, founder of Portfolio Solutions, joining us. RickFerri.com is his blog. Check it out. That's Ferri with 2 R's and an I. Now, tax-wise, the final 2 months of the year can be a poor choice for investing in mutual funds that are held in a taxable investment account. Talk about that.
Okay, so mutual funds have turnover within them, where they're buying and selling stocks within the mutual fund during the year. And a lot of times the funds will incur capital gains within the fund when that occurs. And at the end of the year, they have to distribute those gains to investors. And so if you bought a mutual fund right now, let's say an actively managed fund, and we're not talking about ETFs, a little bit different. We've actively managed traditional mutual funds right now that has gone up substantially this year because the market has gone up. You could be buying somebody else's capital gain distributions, which means you could end up paying taxes on the capital gain distributions come April, even though you didn't make any money. That's one of the problems. ETFs do solve that problem, by the way, because without getting into too much detail, within an ETF, the buying and the selling is not actually done by the fund. It's done by a different mechanism, and so you don't have this problem most of the time.
Now, you wrote an outstanding piece at Forbes.com titled ETFs May Be a Bogle's Best Friend. And one of the points that you made is how ETFs have actually furthered the same indexing philosophy that John Bogle, the founder of Vanguard, has long championed despite his utter disdain for ETFs. Tell us more.
Well, okay, so I have to caveat John Bogle's utter disdain for ETFs because I talked with Jack, actually, what we call him, talked with Jack about it after I wrote that piece. And he thought it was a good piece, but he thought I mischaracterized him by saying utter disdain for ETFs. He only likes he only doesn't like 95% of them. 5% or so are okay. And I would venture to guess that those 5% are probably Vanguard ETFs. But the very low cost ETFs that are tracking markets, like the Vanguard Total Market Fund, as you mentioned, VTI, if you're buying them and you're holding them, and like you were in a normal mutual fund, then Jack Bogle doesn't have any problem with it. So I wanted to start out with that point first. But the second thing is ETFs, being that most of the money going into ETFs are going into low-cost indexing-type products that Jack Bogle championed starting back in 1976. Even though he doesn't like the way that ETFs allow people to trade more, he called it, it's like giving an arsonist a match. These products have, in fact, fostered and promoted the idea of buying and holding low-cost index portfolios. And most of the ETFs that are bought by individual investors are low-cost index-type portfolios that are bought and held for the long term. So it actually has helped promote what his real message is. And that's why I wrote the blog that said ETFs may be Jack Bogle's best friend.
One last thing before you take off, and really quick, you talk about precision in mutual fund labeling and how it's important to investors and adds to the credibility in the marketplace. How is the mutual fund industry, do you think, doing when it comes to properly labeling their products?
Terrible. I mean, some of them are labeled well. The SEC says that 80% of the securities in a mutual fund or more, if you're going to put a label on a fund, then 80% of what's inside the fund has to be in the product that you're saying in the label. But I think that there's a lot of mislabeling going on. Even indexing, calling something a total bond market, when in fact there are no index funds that actually capture the total bond market. So you have to really kind of watch out for that.
Well, I want to have you back. We'll talk about that more. In the meantime, go to rickferri.com. That's with 2 R's and an I. Check out the ETF book. It's available at Amazon.com. Rick, thanks for joining us.
Thank you for having me, Ron. I appreciate it.
This is the Index Investing Show. I'm Ron DeLegge. We'll be right back.
The Index Investing Show with Ron DeLegge.